So you want to buy a house, you want to improve your credit, or you just want to be more financially aware. This is the place for you. My name is Betsy Hughes. I have over 35 years of experience in the mortgage and real estate industry, and today we are going to be sharing some differences between a pre-approval and a pre-qualification. So this has long been a question. Different people have different definitions of each of them. Typically, the difference between a pre-qualification and a pre-approval is that in a pre-qualification, your credit maybe has not been pulled, and I think that would be how most people would define the difference. I'm going to take that a step or two further, and I'm going to say that you technically do not have a pre-approval unless your loan officer has pulled your credit, but has also looked at all your documentation. So they have looked at your pay stubs, your W-2s, your credit, obviously, but also your bank statements. And I'm going to talk a little bit about why each of those are important. So one of the things that is so frustrating to me as a loan officer that I see happening in our industry, and I hear people get frustrated about, is that they've done what they think is the pre-approval, and then they go and they find a house, they write a contract, they're processing the loan, and they find out that for some reason they can't get the loan. And I want to share some of the reasons that I think that happens and some ways to avoid it, so that as you're working with a loan officer, if they're not asking for these things and if they've not looked at these things, then it might be something where you want to question that. You may want to look at going to someone who is going to do all of the upfront work for you. So let's talk first about credit. Credit is important to know what the credit score is, but it's also important to know if there's anything on the credit that maybe you're not aware of. So I've had a couple of situations in my career where I had one situation where they actually had a house that they were going to sell. It was under contract, they were ready to sell it. They were moving to a different town, which was where I was. And when I pulled their credit, they waited to do this until after their house was already under contract. And they didn't realize it, but they had 2 mortgage late payments on their credit report, and that was a big surprise. Now, we were able to do the loan in the end, but there were some additional steps and some things that we had to walk through that they did not realize. So things like that can be a problem if the credit isn't looked at and reviewed. And here's the other part of that. It isn't just pulling it and saying, oh, your credit score is a 703. It's actually looking at the credit report. If there was a bankruptcy or if there was a foreclosure, making sure what the date is that was discharged or that the foreclosure deed was issued, because the information that's on the credit report is not always the same as the supporting documentation that goes along with it. And so if there is something like that that's a little bit more complicated or a little different on the credit report, your loan officer should be asking for that additional information, especially if there was a foreclosure. I cannot tell you how many times it's come up where the information on the credit report shows a certain date, but the foreclosure deed was actually done significantly later than that. And if there's a wait time for you in terms of the loan product that you're going with, the loan type that you're going with, you need to be 100% sure of what that foreclosure date was. So that is, again, going another step further, where we make sure that we ask for a copy of that foreclosure deed. And we as loan officers have ways to get that information and to help you to figure that out. And again, that's part of what we need to do at the pre-approval. So that's just a couple of things that, specifically looking at the credit report, there really, really is more to it than just looking at what the credit score is. Okay, so let's move on to income. So this is pay stubs, W-2s, tax returns. So I want to give you a couple of examples of why it is critical that information is provided up front, because we know that there is a difference between someone who earns income on a 1099, for instance, versus a W-2. You as a borrower may not know that. You might not realize that there's a difference in how we have to look at and calculate that income. So if you're a 1099 employee, we're going to need to have tax returns to go along with that. Because you're technically considered self-employed, you have the ability to deduct things, and we're going to work off of net income on those tax returns, not gross income. Where if you are a salaried employer or employee, that's not an issue. If you are a W-2 hourly employee, that's not an issue. But again, can tell you many examples of people who didn't realize that they needed to have that conversation with the loan officer up front, that they were 1099. Because again, as a borrower, you don't know this, right? You don't understand that there's a difference. You would never have a way to do that if you didn't do what we do. So self-employed borrowers, absolutely critical on self-employed borrowers to look at tax returns, actual tax returns that have been filed, not profit and loss, because those numbers can be different depending on the type of reporting that's done and all of that type of thing. So actually looking at the documents that would be submitted for the underwriting of the loan. Okay, the other thing that I want to talk about are some other types of income, right? You might have gotten a raise, you might have had a gap in employment, you might have overtime, or you might have a bonus or commission, and maybe you've been earning that, you've been at your job for 5 years and you just started earning that commission a year ago. That may be income that we can't use for the qualification, and so we've got to be able to look at all of that. And so looking at the previous 2-year history, the year to date, like those are all things that as a loan officer, before that pre-approval letter is issued, that we should be looking at. Okay. Next, I want to talk about bank statements. And this is very interesting because I think there are a lot of times that bank statements don't get asked for at the pre-approval. And I've done this for a really, really long time. And I have seen a lot of things that happen and that come up again during the actual loan process because we don't look at the bank statements up front. So I'm going to give you just a couple of examples of why we would want to ask for that. So the underwriter is going to be looking for 2 things when we submit those bank statements. The first thing they're going to be looking for is large deposits. Are there deposits that are not payroll related, that are out of the ordinary, that we would need to look at and verify where that money came from? Because there are certain places that money can come from for closing, and certain places that it can't come from, right? And so if your money is kept in a box or under your mattress at home and you want to put that money in the bank, right before you're getting ready to close, that's going to be something that could potentially be a big problem. If you have someone who is going to give you money as a gift to help you with down payment and closing costs, for most loan programs, that's fine. But there are a couple of things that need to happen in that, depending on the loan program, documentation that we would need to have. But the other thing is, if you're purchasing an investment property, you can't use gifted funds. And so if you have a deposit that has gone into your bank account within 60 days of closing that has come from a family member on an investment property, we can't use that income, right? I just worked on a loan where the borrower indicated that they had put a number on the application, the online application, and the money was actually not in the bank yet. And so that was one of those situations where we had to have a conversation about where that money was coming from and how we were going to document it. So all of those things are really, really important to make sure that you have a pre-approval. So when I'm talking to my borrowers and I'm saying, I know at pre-approval this may seem like a lot that I'm asking you for. The reason that I'm asking for that, again, is because I want to be absolutely sure that when I take that loan application and they have found a house and this borrower is going into the actual process of the loan and underwriting and all of that kind of thing, that we know exactly what that looks like and we're not going to have any surprises. So those are the things that I would say to you as someone who's been in the business for a long time. That's the difference between a pre-approval and a pre-qualification. Not all encompassing by any stretch of the imagination in terms of all of the things that we would look at. But I hope this is helpful to give you a little information to understand why we would ask for everything up front. So I am at the end of this going to ask if you feel like this video is helpful. There are going to be lots more videos of different types of things. Would you please subscribe to the channel? Would you like, and would you make a comment if you feel like it was helpful, if you have another question, or if there's a different type of video specifically with information that you would like to have?